Hi there. Happy Friday afternoon. Minnesota Real Estate Journal, RE Journals. Welcome to Breaking Through the Disruption. Today's topic is industrial real estate, Minnesota. We'll do a little bit of housekeeping first, and then we'll turn it over to the panelists. Okay, today's event is, we do have continuing ed for today's event, but before we do that, I got to thank our sponsors. So IREM, SIOR Capital Partners, I say this every single day we do one of these webinar events. We really miss doing live events, but we're super appreciative of the ability to be able to pivot into doing webinars. We couldn't do it without sponsors, without good speakers, and without people coming online and watching. So we're deeply appreciative of our speakers and their ability to help us do our thing so we can have webinars while we're waiting for the climate to clear so we can get back together again. So again, today's event was approved for continuing education. Let me get our heads out of the way so you can all see that. This webinar has been approved by the Minnesota Commissioner of Commerce for 1 hour of real estate continuing education. First question here says, how do we track attendance? So when you logged in, you got time stamped in. So we have that record, but just as a belt, make sure I would go to the chat room right now, enter my name in, what company you're with. I see some people are putting their license number in. All that's great. It's a nice belt and suspenders approach. We'll make sure we have it. When we're all done, Katie compiles all this and she sends it off to the state. So I will also have to ask you 2 questions. We don't have a test to do this, but we have to know that you're paying attention. The state requires this, and what they said we could do is ask a question at 2 random times for each hour. So I will pop in, I'll interrupt Jim and gang, and ask a question related to this event, and then you have to go into that chat room and answer it. And then that will timestamp you that you're watching that too. Then when you log out at 2 o'clock, it will timestamp you on the way out. But again, I'll ask you to just put your name in, belt and suspenders, we'll get that done. If you have connection issues, so if you see a speaker freeze up or you can't hear their voice, I get lots of messages in the chat room, hey, I can't hear your voices. This time it's you, it's not me. Not like we're dating, but I've got 4 bars right now. I know we're good. So you should be able to hear everybody. So hit that reconnect button. That solves 90% of the problems. If that doesn't solve it, use Google Chrome. If that doesn't solve it, just close your browser out, go back to the link we gave you, click on it. You should be good to go. We haven't had many issues beyond that. Also, there's the chat room. That's where you're going to answer asks a question and you and the audience know the answer. It's okay to also put that in the chat room. I will ask a poll partway through, so watch the polls is right underneath chat now. So if you have to log off and you miss some of this, or you want to send a recording to a colleague, this is the address. Write this down right now. We'll also mail it to you, email it to you when we're all done, but it's good to write it down. Video replay, rejournals.com, video replay. I'll take it to our YouTube channel. You can also find all of our other events there as well. Well, here we go. COVID-19 and the Minnesota real estate industrial market. I am going to get out of the way and let these guys moderate their own panel.
Thank you, Todd. Thanks, the Real Estate Journal.
As soon as I can find Jim.
There
we go. Great.
Appreciate it.
I'll bow out. I'll still be here, guys, if you need anything.
Yeah. Good afternoon. We were fortunate to have a very interesting group of people this afternoon, all with different insights and perspectives on the post-COVID industrial real estate market. First panelist I'd like to introduce is Peter Mork of Capital Partners. Peter on the left there. Peter, his 8.1 million square feet industrial portfolio makes him the #2 owner of industrial real estate in the state of Minnesota. Peter is one of those self-made local stars who went from being a St. Thomas cadet to one of the most important investors in the upper Midwest. Peter was #1 in our market until our next panelist, Mark Colesrud of Colliers, brokered the largest sale by square footage in the history of the state of Minnesota 2 weeks ago, Mark and his team of Colin Ryan and Dave Bergen closed a sale for CSM as seller of 59 properties and 7 million square feet. It's Blackstone Group. Last year, Mark sold the 2.5 million square foot portfolio of industrial equities to Blackstone for $275 million. So $1 billion in sales in the last 12 months. Not a bad day in the office. That's why he looked so relaxed there in his home office. Clearly, Mark had some stories to tell, but he's not the kind of a guy who spikes the ball once he's in the end zone. So I'll do my best to pull it out of him. Dwayne, and our third panelist is Dwayne Poppy. Dwayne is a lead associate, is a longtime industrial specialist in the Twin Cities. He started his career 20 years ago with Cassidy Turley, and now Dwayne is the managing principal at Lease Associates. Dwayne also currently serves as the mayor of Oscar. And I think he'll give us some pretty interesting insights in how the economy looks from an initial point of view, the impact on taxes, and where the revenue is going to come from to pay in this new post-COVID environment. The interesting thing about Dwayne that always makes me chuckle is that Dwayne, as you might know, is a semi-pro world champion log roller. College, a lot of time practicing staying on top and spinning that log anyway. That's Dwayne Poppy. All right, so let's get started. Mark, I have to ask you, give me a flavor of what it was like to lead a brokerage team to close $1 billion deal. Your partners, Colin Ryan and Dave Bergman, over the last year. You had the smartest, most successful real estate investors. You had the smartest private equity group, Blackstone, over $300 billion in equity, investing for pension funds, sovereign states, and wealthy investors. How do you say, hey guys, let's just split the difference?
Yeah, well, I don't think that happens in that type of a transaction. But, if you start the transaction with the right, right people, it all kind of happens, and one comment you had was, how do I lead a team like that? Well, I don't ever even see myself as a team lead, but just a team member. Colin and Dave are my partners, and, they don't need me leading them in their day-to-day practice, and so I think we kind of operate as a very collaborative group with a larger organization. And so when you come to a company like Peter Mork, if I'm going to try to sell a large portfolio to Peter or someone like that, if you come with the right resources and give them the right information, it's easier for them to make the right decision. So that's really as a team, as we lead into these transactions, it's what information does it require, and CSM and Gary Holmes and John Allen, Industrial Equities. I mean, they know more about real estate than I'll ever know. And so I didn't ever approach them thinking that I was going to teach them about something more of. I just wanted to really provide the right information, the right service, and kind of just humbly as a servant, try to move forward. And when you work with a group like Link, Blackstone, I mean, it's pretty incredible, the intelligence and the resources that they have. But boy, I'll tell you what, it really went well in that all the people just operated, and to close when they did, it's pretty incredible.
So what are the kind of questions you get asked after a couple of beers, sitting at the bar with friends? What's it really like dealing with some of those incredible entrepreneurs here in the Twin Cities, guys that have just, incredibly successful, incredibly smart, incredibly intense. Do you get many second chances?
Yeah, it's a one strike you're out kind of business. And I think if you approach it with that idea, and both of these companies, we had earned a relationship with them that was wonderful. But relationships can end like that if you handle yourself inappropriately. And so my dad always told me, and my dad's probably the best person in the entire world to give advice. He said, if you provide a good service, and this would be the advice for everyone in the business, if you provide a good service, the income follows you. You don't need to worry about that part of it. And so I just, if you enter into it with any of these guys, but there was a couple moments in every transaction, every transaction seems to die 3 times. And of course that happened, but you know what? Calm, fire in the fire is the key in those moments, to just say there's always a way to resolve a problem.
Yeah. So Peter, in the post-COVID world, it seems to me there's trillions of dollars are coming into the marketplace with the Fed. The Fed has said, we'll do whatever it takes. There already was a flood of capital in the market. It seems to me that with interest rates near zero, is this the perfect situation for industrial real estate to do well?
I believe so. I think it was great pre-COVID, and I think it's going to be great post-COVID. And there's no question that there's a lot of money going after industrial real estate. So I think the challenge is the same, finding that opportunity. But once you find that opportunity, the new challenge post-COVID is finding the debt. Because you really got to have a relationship with a local banker that understands commercial industrial real estate, or your chances of closing are going to be difficult, because finding debt to close is going to be the new challenge in the post-COVID.
So what do you see as some of the biggest challenges in that you're going to be looking at? What are some things, concerns that you might have, or things you think about at night?
Well, right now you really have to underwrite the tenants and understand the tenants' credibility, their sustainability, their ability to weather the storm. And, quite frankly, industrial real estate tenants are doing great. We collected 98% of our rent in April. We got 400 tenants. I think May with the PPP program, everyone's looking good. So I don't anticipate industrial real estate really seeing a big leg. And there's a lot of money that wants to invest in industrial real estate. And there has been, and it's going to be even more people that want to invest in industrial real estate, because the other asset classes for real estate are concerning, to put it politely. But, another challenge is we're not going to see, and Mark can speak to this, we're not going to see portfolios of industrial real estate being offered anytime soon, because the institutional debt market that finances those is basically on the sidelines. So with that being the case, what portfolios aren't going to come to market, because they're going to be, the price is going to go down, cap rates are going to go up, and it's not justifiable, because the underlying metrics of industrial real estate are strong. We got low vacancy rates, like 4.5%. We've got pent-up demand. We've got good absorption. We're going to have good absorption. And quite frankly, new construction is forthcoming, but it's not at the level that will support the absorption demand. So I think industrial real estate is going to do well. And the challenges, again, are finding the deal. And then when you find the deals, it's making sure you have your debt in place.
You sound like you still have a big appetite. You're going after number one. What is Blackstone have, like 14 million now, Mark?
What's that?
Doesn't Blackstone have about 14 million? Peter has a ways to go. So, but
less than that. But I wouldn't bet against Peter, that's for sure. Yeah, we actually transacted with Peter on a transaction just earlier in the year, and the way he's proceeding, I wouldn't bet against him.
Well, we're excited. We've got a appetite, a lot of partners, and don't lose my phone number, Mark.
Yeah, I know.
Hey, Dwayne, I've for you. What about tenants and paying rent? Have many tenants reached out to you to talk about, well, what can they do for advice, or what have they asked about? What kind of forbearance, rent forbearance is the word, or
yeah, there a number we've had those conversations with them about, is this something I should do? And a lot of them, as Peter had mentioned, a lot of them are still paying their rents. I think because you look at a lot of the industrial tenants, a lot of them are the essential businesses, so they've been open. They haven't had to completely shut the doors. They've staged their manufacturing areas and some of the production areas where the people are spread out and still be able to work, keeping social distance. But a lot of them, they're still looking, and they're seeing this opportunity as maybe there's a way to actually enhance the workforce that they have with the higher unemployment, and continue to bring people in and interview them and try to add them to the team. So a lot of the conversations have been more theoretical, and typically, going into this, I mean, we're only really a month and a half, And if you're weak financially going into it, it really kind of, highlights on the strength that what you are as a tenant. So there probably had some issues going into it, but I wouldn't say, it's really wide across the swath like, 08, 09, where people are just, losing things and weren't paying the bills.
In many ways, I'm sorry.
Jimmy, I could maybe expand a little bit on that just from the landlord standpoint. It's been interesting this last month, and it's been refreshing too, because a lot of the smaller tenants, they call us initially worried that, what's the PPP loan? Are we ever going to see the money? What can you do for us as a landlord? At Capital Partners, our motto is we're here, we're going to work with you. We're not rent abatement, the wrong word, it's more rent deferment. And again, I mentioned we collected pretty well in April. Now, come May, we're talking to these tenants because checking in on them, being in front of the game, and they're saying, hey, we're okay. We got our check from the government. Our bank is working with us. Our vendors are working with us. We're going to get through this. So it's really neat to see the Minnesota work ethic and opportunity to get creative and make it through it. What I did find though, was really the tenants that are looking for rent relief are the larger tenants, and they are the ones that really don't need it or can justify it. But they're saying, can you give us some type of rent relief or rent abatement or deferment? Because my competition is asking for it. If my competition gets it and I don't, I'm at a competitive disadvantage.
Right. For many people, the first quarter of 2020 was the best quarter ever in industrial real estate. So there's a whole lot of momentum going into the post-COVID world. But what are the new rules of the road? I've asked a couple of brokers about some brokers' opinions of values on properties they're doing. And a couple of them said, well, once you're valuing a property today, really any comps before March 15th aren't really very valid because we're in a situation. How do you adjust when you're thinking about a property, valuations, market rates in the post-COVID world? Any thoughts on that? Mark?
I guess I could answer that. One of the things that I've seen, we're continuing to do valuations for owners and are contemplating when the right time will be to launch the next listing or the next opportunity. One of the things that has to happen is you have to underwrite what the tenant is, who the tenant is, and so let's say a tenant makes paper cups and sells them. Well, that could be a good business, but what if they sell to an industry that's so hard hit? And so it's who is the tenant and who is their customer? So there's deep credit understanding of what's going on right now and what their exposure is and how many leases around the country. And then you look at, like, one of the things that we're really fortunate in Minneapolis is that we have a very diverse real estate economy here. So we have all four corners of our metro, Minneapolis, St. Paul, have pretty, really solid product. And we have they're varying different types of real estate too. And all of them are successful, which is not similar to a lot of other markets. So in Minneapolis, we enjoy a high finished product, enjoys great success, just like a bulk product does. In fact, some of the biggest industrial buildings that are being built around the country wouldn't work as well in Minneapolis, but we have this highly intelligent, kind of resourceful community, like Peter had mentioned, and we have health science and agri-science and all these other industries that are filling these buildings up. And so I think that as people underwrite their portfolios and what is it worth and what could be done, there's a lot that goes into it, and then we just have to wait and see with the debt markets, how they wake up and what they come back like. So.
I think on the single user side, I don't think there's been much or any going to be price adjustment on that. I mean, we just did a valuation for a company that was looking for a building, and the question came up. I mean, is there now going to be a deep discount on, single user buildings? And I don't think that's the case. I think, the vacancy is so low and there's limited supply of, good quality single user buildings out there. And I don't think we're going to see a price reset like, in the past.
You think there'll be a flight to quality? You think there'll be a more of a chasm between very functional, high-end real estate and some more dysfunctional? You think the market will start to separate in that way? Peter, what do you think on that?
I think so. I think that we're going to see some of the more obsolescence issues kind of being more of a problem for a property, and that they're going to have to kind of deal with that. And it might allow some opportunity to reposition some of these buildings too, to be a different in the way that they compete. And I also think that the way the real estate is being operated is really going to matter. And so, as an operator, you can get around some of the obsolescence by how you operate it. And so I think the operator is going to really matter as well.
I think to Mark's point, the challenge is that the quality real estate, the high bulk industrial that's well located, is going to be very difficult to put under control and purchase, because we're going to have so much money that's going to come from pension fund groups that have low cost of capital or can buy with all cash. And really, to compete with those properties, you can't. So if you're a local investor and want to get into industrial real estate because you look at all the asset classes for other real estate and they're scary, retail concerning, obviously office, suburban office is concerning, hospitality, multifamily. So it all kind of funnels, in my mind, back to industrial. Industrial was the darling before this happened, and I think it's going to come out to be even more of a darling class of real estate to acquire after COVID. Well, again, you're going to have so much money wanting to get in industrial real estate, and that money is going to be very, very cheap for these investors that have capital and can close all cash. How do you compete against that? So I think those cap rates are going to get driven down so much that you're going to have to find other properties and reposition them, like we're talking about, if you want to get in the game. And then that also is leaning very heavily on your broker. Your broker is really important these days, because they're going to have to educate you if you don't have market knowledge on the market, on the time to release, how to get creative, and the pitfalls of buying an asset that has some hair on it.
Interesting.
Gentlemen, I got to jump in and ask a question. Sorry to interrupt you. It's a good conversation. If you need continuing education, you're online right now. Pay attention. Hello. I'm going to ask you a question. Put your answer in the chat room. That'll log that you're still here. What, in your opinion, what direction are industrial rents going to go? Up, down, or stay the same? Put your answer in the chat room, and we'll kind of read them as they come in. And thank you, gentlemen. I'll be back in 20 minutes or so.
Interesting. I've been reading a lot of reports lately on the industrial real estate market. And many people think the industrial will be the big winner, with pent-up demand being unleashed in the market over the next 2 years. And this premise is based on three concepts, and I'd like to just share them with the panel and get their thoughts. One is that the supply chain, what we've seen with the just-in-time, with the PPE equipment, people are going to second guess that. They're talking about safety stock increasing. They're talking about inventories, increased inventories, which would add to more warehouse. With reshoring, people are concerned about really critical things in the United States being dependent upon overseas manufacturing, and that will be coming back. The Minneapolis medical device industry, that's been a booming part of our marketplace. People think reshoring will come back, and Minneapolis will benefit in particular. Any thoughts on that concept? And then the e-commerce. We all know about e-commerce. They said that the online grocery business, which is more and more going to online, $1 billion in its sales of online grocery sales adds to 1,250,000 square feet of warehouse. With the post-COVID situation, this grocery business is about a $630 billion business, and currently it's about 10% of the total. But the online sales went up 3%, unbelievably, in the first month or so of the crisis. What do you guys think about that? Do you hear much talk for freezer cooler space? Do you hear more talk for larger buildings? The scuttlebutt for e-commerce here in the Twin Cities. Dwayne, do you want to talk about?
Yeah, I think those are all things that are going to continue to contribute to the interest and the absorption of industrial real estate. Just because of that, I think a lot of this e-commerce this has been forced adoption for a lot of people. I think there might have been a number of people that were hesitant to use it initially, but now based on the current situation, they used it, realized, this is kind of easy. As we joke, it's probably like the dishwasher when it first came out. People are like, I'm not buying a dishwasher. And then you're like, oh, you can throw the dishes in there and I can walk away and do something. That's pretty nice and convenient. So you're starting to see, I think, an older generation using it. And I think that just all continues, to add to the inventory here. I mean, there was that one stat, they said, based on all this, the online retailers, the e-commerce, are saying that they're going to house more inventory. So they don't have shortages of different things. And they said, if you take a 5% increase in total inventory, that translates to 750 to a billion. That's what it'd be, 1 billion square feet needed in the entire country. So, I mean, it's not going away. It's just going to continue. The e-commerce is going to be a bigger part of, the retail side.
Where do you put these buildings? I mean, these buildings typically are not, variety size buildings. Are highly specialized. What about the land? What about labor? What about the people that service them? What's your thoughts on that?
Yeah, I mean, there's, obviously everyone's scrambling for big land positions. And I mean, there's a couple, around, you got a couple in the Northwest, with, Scanal, Prologis up there on the east side. You've got, Ryan Launch has got some stuff. You got stuff down in Lakeville again, but everyone's looking, it comes down to labor. I mean, as you look and read in the paper, all the issues that Amazon has down in Shakopee, with their labor and trying to continue to keep people down there. So, I mean, that's the biggest thing is, the labor and the transportation, because those are such a big component of the total cost to, run these fulfillment facilities.
Mark, speaking of Amazon, I see their facility down in Shakopee sold recently. They're 800,000 square feet. Talk about concern about backfilling and modeling an asset. Talk a little bit about that in terms of how it would look at that.
Well, Amazon has enjoyed a lot of interest from investors around the country, and their business model is proving to be very, very successful. And so there's lots of interest, and there's lots of go get them kind of mentality. But I would say that if it wasn't leased, that would be a tricky part. And so there'd be underwriting. It's all about the credit. So what do you do with a big building like that in Minneapolis? It's different than it would be in Indianapolis. And so you have to underwrite how strong the tenant is, and then what happens the next time around. But they executed really well on that sale, and hats off to that team. And Cush did a great job bringing in a buyer, and MetLife will enjoy that for a long time. So,
Jimmy, I can just comment briefly on things coming onshore. First off, I think everyone realizes we all kind of have short-term memories, and labor and materials are cheaper overseas. So competition is utmost importance. And if your competitors are still being overseas, it's tough to bring everything over here, and it's going to cost you more for labor and materials. But that said, I worry that the flex market, where you have these tenants that have a third office and 2/3 warehouse in the back, and they were fine with 14, 16, 18 clear. But now they're getting pushed upon by their clients to store more inventory in-house, which is in turn have them look for still smaller bay but higher clear buildings, because obviously when you rack up, it doesn't cost you anything more per square foot. So I worry about the flex market having an effect there. And I also think that the elections coming up will also influence on how much push there will be to bring companies back to America, or if not, it may go away.
Sounds good. Speaking of elections, good luck, Dwayne. Don't you have one coming up in November?
Yes, I do. My name will be on the ballot.
All right, attaboy. Should be an interesting election this year. The Twin Cities industrial market closed the first quarter with nearly 570,000 square feet of absorption, remained low at 4.4%. Do you see that continuing? How could it change? I mean, CBRE predicts industrial leasing volume will recover to pre-COVID levels within 12 months. And we see a 6% GDP growth in 2021. You guys think, is that too optimistic or pessimistic? What do you guys think? Those are some pretty bullish numbers for industrial real estate.
I think it's going to continue to go along, but as I mentioned earlier, a lot's going to depend on the election. I mean, if we can continue on into 2021, or will there be some major shift in policy that goes on, in regards to onshoring? I think a lot of that, it's all about chasing cheap labor on the manufacturing side. That's why it went from, everybody had it locally, then it went to regional, then it went south, and then it went to Mexico, then it went to China, and then it's already starting to go to, Southeast Asia, into India. I mean, it's just chasing cheap labor. So some of that, it comes down to tariffs on some of the products, and the critical nature of the manufacturing. Those are the kind of jobs you see coming here. And, but I think, like we said earlier, tenants are still strong. Tenants are still, need to do something. I mean, when leases come due, and I think right now they're taking a pause. They're realizing that, they can end up trusting their employees more. Maybe they don't all need to be a space, a desk for them. Maybe it's more hoteling type situations or some breakout rooms. So the space may change a little bit, but I think you're going to continue to see that demand going forward.
Yeah. Peter, what are you banking on?
Well, what Pop said, I think, is all true. And I think that, 12 months to bring back industrial real estate, I think I'm more optimistic than that. I think, after we're allowed to go back to work, I think 6 months from that point, we'll see great leasing activity. We'll see great absorption. I think we'll see some new construction coming back. And I think the debt markets will hopefully settle down, and people can, invest at, where the interest rate should be to buy industrial real estate today. Industrial real estate, all the fundamentals are there. So the fact that institutional debt is on the sidelines and banks are requiring, higher debt coverage ratios, et cetera, are unjustifiable in my mind. So I think everyone just needs to relax and settle down and realize the metrics of industrial real estate are strong. They were very strong before this. There's no reason why they won't quickly catch up to pre-COVID numbers. And I'm bullish to the point that the cap rates that were setting new benchmarks in fourth quarter of 2019 and early 2020 that Mark Holdrew and his team have done, and others, I think we're going to see even lower cap rates in 2 to 3 years. I think 2022, 2023, again, I'm just such a believer that there's so much money is going to want to buy industrial real estate. I mean, the bond market you can't get anything off of that, and the stock market is questionable, but you can only have so much money put in your stock market. And if people want to diversify their portfolios, which everyone does, real estate's the next move, and in real estate, industrial real estate is a logical move.
Okay, let's talk about cap rates for a second. From one point of view, if you said a couple of years ago that the 10-year Treasury would be 6, and that 5 or 6, 7 countries would have negative 10-year interest rates, it would be unbelievable. Or that the price of oil would be down to $8 or $9 a barrel. You just wouldn't believe it. I mean, the world has been throwing such incredible information at us to process, right? It just seems as though the cap rates in this little in the marketplace need to come in line with the real underlying rates of rates with the Fed declaring they're going to maintain a zero interest rate. About that, you see downward pressures on cap rates, or does the risk of collections offset that and force people to build in these premiums because they don't know? Would be my guess. Do you think that's what's going on?
I'll weigh in first, maybe. I do think there's a great potential.
Hey, buddy, I didn't mean to wake you up back there.
I believe that with the solid nature of our market, that cap rates in Minneapolis, have the potential of going down, and the world economy has to kind of follow along with that hope and that dream. And I think that we're going to see more and more where smaller portfolios get bundled up with other portfolios and larger deals. And so the really significant money that's out there has a struggle in finding deals large enough for them to be interested in. I think there's going to be a real demand for industrial land, but I think there's going to be a pause there's going to be an opportunity for some people to jump into the industrial land market where that really hasn't been a gap in that. So there'll be some opportunity. There'll be some people that'll give up some, contracts that they have on land in the short term. So there's probably going to be this short term thing that's going to happen that I think cap rates are going to go up short term. And then I think long term that has a potential, if everything else doesn't go crazy in nuclear, that cap rates could continue to fall. And yeah, Scott Fredericks wanted me to show my antlers, so that's pretty nice antler.
Well earned. Peter, what do you think on the other day talking? You said that you thought cap rates are just one component, that people really, are looking at internal rates of return. What you're really looking at is a measuring of the rent, the cash flow, the quality, the durability of cash flow, and obviously the residual value. When you buy a property, you're thinking, how do I create additional value here? Talk about that a little bit, some of the mindset that goes into it and how it might impact cap rates going forward.
Yeah, well, I think cap rates a big function of debt and the credit worthiness of the building or the portfolio you're buying. So you're not going to see any better debt terms. I don't know when, and we haven't it be basically zero. So someone can go in and tie it to a 30-day LIBOR, and what's the 30-day? The 30 days probably at $1.25. So you can go, float debt for 30 days and get, a low 3 interest rate. Well, that's going to drive down cap rates. And I disagree with Mark. I don't think we're going to see a spike up in cap rates on quality industrial real estate. I think everyone's sitting on the sidelines just waiting to see those listings come back, because there really aren't any listings out there of any size that people have an opportunity to bid on. So I think cap rates are going to go down. They're going to continue to go down. The single tenant market concerns me. We've had 2 buildings where we've did a sale lease back on 10-year lease, and the tenants didn't perform through their 10 years. Single net tenant deals are concerning. I think the COVID deal has affected companies and tenants that no one would ever have thought would have been affected by a downturn in the economy. But this COVID put everyone on par, and it affects everyone. So I'm a believer in multi-tenant, because you can stagger your rent roll, you can stagger your tenants, you have less inherent risk, you can spread out throughout the portfolio. I think the challenge is competing with such cheap money out there from larger institutional buyers that really create an unfair playing field, because their cost of capital is 200 to 300 basis points cheaper than someone that can go get local bank debt.
Going forward, everyone's always concerned, well, how long is this going to end? Oh, there you are, Todd. Do you have another?
I do. I have to ask another question. I can't do it every 20 minutes, so I got to do it at random times. I want to let everybody know real quick, that in the poll section, I added that question about rents and what direction you see them going, because a few people asked for a tally on that. So go, if you haven't yet, a few people did. If you haven't yet, go into that poll and say whether you think they're going up, down, or neutral. And after about another 5 minutes, I'll publish the results and y'all can look at them. I'll jump back in. But okay, back to the continuing ed people. Go back into your chat room and answer this question. When do you believe personally that we are going to be back to normal? And by normal, I want to define that as you see a baseball stadium full of people. So month and year, December 2020. Well, of course, we don't play baseball then, but some other sport, right? Hockey for Minnesotans. But what month and year is it that you think you'll see a baseball or some other stadium full of people? And I will log out. Don't forget about the poll. Thank you. Thanks, guys.
That's an interesting question. That's a very interesting question. But, you know, to talk about this post-COVID world, at our company, they're forecasting that the industrial will return in 12 months, that they say that the office may take 2 years, and the retail may take 36 months. And primarily, the issue there is that many of the participants in the retail, obviously the major players will stay in place, but many of the smallers will have to get reconstituted and start all over again. So it's going to take a little bit longer time. That seem, you know, in terms of the kinds of changes you see going forward, does that seem consistent with your view on the way things are likely to turn out? Dwayne, you want to start with Dwayne? I can't hear you, Dwayne.
You're muted.
Yeah, there we go. No, I think we're going to continue to, it's going to take us a little bit, you know, like we had mentioned earlier. I think people are just hit the pause button a little bit on their business and trying to understand, you know, what does that look like going forward? And also too, what is that new normal that people are going to come back to, you know, with the social distancing, the, you know, increase in, you know, cleanliness of spaces to prevent, you know, or have this ongoing in their space. But so those are, I think, what's going to cause slight pause for people to do something as they try to figure that out. But I think it's going to, once they do, and it's like any time in the market doesn't like uncertainty. And as soon as you understand the uncertainty, know how to frame it, business is smart enough, they figure it out and move forward. And that's, you know, you see that over and over again, whether it be elections or, you know, economy or some sort of world event. It has that pause of uncertainty, then people figure it out and move forward.
You know, Mark, when we were talking the other day, you said, and it struck me as something really important for people in the audience to hear, but you said at this time and in this part of the market where there's this pandemic going on, it's real important that the client have a sense that you've been through something like this, or you've been, you know how to handle it, or you have to have some level of, you know, calm about yourself so you can think through the right strategies to take. Tell me more about that thought, because I found that to be pretty interesting. The idea that people our customers or clients are coming to us looking for some sense that we've been through this, or we've seen this before, or we know how to best maneuver through these choppy waters.
Jimmy, I don't know what you're talking about. We never talked about that. So I think that the point that when we were talking about it was, you know, when you have the opportunity to get caught up, whether it be Zoom or in face-to-face or however you do that with your client, you know, just understand. We have to first listen and hear what is the client experiencing, because everyone's rent roll and everyone's portfolio is different, and what they're doing and how they're going through it is different. And then to think through how to help and serve through that, you know, and what the part of the business that we are involved in is the sale of investment real estate. And so for us, usually if we're in the room having a conversation, it's like they'd like to monetize it, whether they need or would like help to find new capital to come in, or they need to find new debt, or they need to find a buyer, or they want to buy and do just the opposite. They want to be those things for different people. And so one of the things that I always, again, kind of similar to the comment that I made earlier, is, you know, how can we help? If we're just really think of ourselves as humble servants, that's really what the business is, right? We're just being a servant and trying to help with information and go to their organizations and go to the part of where you can get the help for these people. So I think that's kind of the conversation that Jimmy, you and I had. So.
And some of us are more humble than others, but that's a nice way to put it. Thoughts on that?
Jimmy, I think that we're going to see a difference of marketing vacant space in the future. I think, prospects are going to be somewhat reluctant to go into a building with the brokers and a team of people, architects, etc. So I think we're going to see, more virtual tours of marketing your building or your vacancies. And I think we'll see prospects wanting to do windshield tours first and narrowing it down to just a couple of buildings. And then they're probably going to want to, just enter it themselves and get back to their broker or the landlord.
Yeah, because I think this is going to spur, because you always see residential real estate is always, on a marketing technology standpoint, always seems to be ahead of commercial real estate. And I think, again, these are one of those things that's going to push commercial real estate into adopting some of these new technologies, as Peter had mentioned, with especially virtual tours and things like that, where people go out, shop for homes, look at the homes, understand the homes, and then kind of narrow it down and then call the broker and say, I want to go see that one. And I think you're going to start seeing that. And that's why having, that technology with virtual tours, be able to have that on your space, see it, people can look through it, walk through it and go, okay, now I need to see how the space feels. And then they'll just go see that one.
How often do you see that in the market? Do you see quite a few of the owners moving towards the virtual showings then, or have you already experienced that?
Yeah, I mean, you're seeing some of it, but again, it's one of those adoption technologies that people are like, do I really want to spend the money to set that up and go through all that? And when you end up looking at it anyway, but I think that's going to become more of an important piece for, some of these larger and even smaller vacancies where, again, a person's online looking at it and they call you and say, yep, I toured your space. I want to go see it and, let's do a lease. I think, it's going to just help with transactions. And you just saw within the Catalyst system here through MinCar, there's a place that you can insert on your listings virtual tour links. So, I mean, that's already being incorporated into our system locally.
In this, one thing I've been thinking of in this post-COVID world is that when you go to the grocery store and you pick up your groceries, what's the reason why there's a grocery store there? I mean, you could almost see an industrial building with air-conditioned space with much better access to pick up groceries, right? I mean, there's no need to look at displays. There's no need to look at anything other than you really just want your goods and you want to pick them up. And you think there'll be some kind of, with the e-commerce coming and growing, do you think there'll be some kind of fusion of the industrial and the retail? Like a lot of the CSM product that you sold to Blackstone. Could you see some of those buildings becoming commerce centers or not? Or is that something you think is a little bit too far off?
I think what's interesting is we'll see where these properties are located and what the opportunities. So as the larger vacancies open up and they're located in these fantastic locations, they'll probably see more and more of that. And they don't even all have to be embedded into the city anymore to be able to provide that service, because if you live where I live out in the country a little ways, I mean, we still don't have good food delivery out here. And so they're going to have to start solving for that as well. And so we'll see more and more of that. In the case of the CSM portfolio, they did a really good job of having a cross section of other industries and things like that. And so they might have some of that backfilling it, but they probably won't with all the health science and all the other kind of industries that was in some of these portfolios. But
right.
Be interesting to see.
I think zoning will be a big issue there. Make sure that zoning can comply with that type of excess traffic, et cetera. And I think we're kind of halfway there in a way because, you got Costco and you got Sam's Club and you got Walmart and Target. They're basically big bulk industrial buildings that put on a retail pad that seem to work. So I think we're halfway there, and it would be great if we could take it the next 50 yards.
Yeah, and as we think about we should save a few minutes here. There's 9 minutes left for questions from the audience. But is there anything else anybody wants to comment in terms of the future and how this might accelerate it? One thing I would say is that, I see capacity developing for certain companies with good balance sheets, good businesses, and they're going to be looking for other companies to purchase. They've got the capacity, they've got the infrastructure. So I think you're going to see a wave of consolidations, a wave of mergers and acquisitions once the private equity markets open up again. And I think for real estate, that means more, bigger, modern, efficient buildings, because typically when people do consolidate, they want to get the efficiencies from a larger operation. That usually means new capital equipment, material handling, higher ceilings. It'll be interesting to see what happens with WPT's development in Eagan, which is on a phenomenal site. Choice location, see how they do there. I'm sure they're going to do very, very well. Any thoughts on that, Mark, Peter? Or sound reasonable?
Yeah, I think you're right on, Jim. I think we're going to see that. Well-located real estate is everything, right? Well-located real estate can do well no matter what. I think there's some certainly efficiencies we're seeing in new construction with the speed bays and the higher clear and all the bells and whistles on the docks and what everyone's looking for. But I just think Minnesota is conservative in their approach of speculative new construction. And we don't have, I think, groups of the past, the Ryans, the CSMs, the Gary Holmes, taking those risks. I don't see them doing much of that without significant pre-leasing, at least in the next 12 to 18 months. I think absorption and pent-up demand for new space is going to continue to drive, hard to believe, the vacancy rate even lower, which is 4.4% today, which is going to translate into landlords wanting to increase rents. And
do you expect any new construction? Which ones would be, besides, what do you see for new construction? Anybody coming out of the ground you can predict?
There's a handful of sites around that, that are kind of pad ready. I mean, I think a lot of them are waiting, as Peter talked right now with some of the significant pre-leasing done, having the pad ready to go in 90 days you'll have the building up. I mean, you can negotiate the lease as the building's going up. So I think there's still going to be there's a couple of big blocks of space that have gotten taken down recently, and there's a handful of pad spaces ready to go.
All right. Go ahead, Pete.
Just all that said, there was a couple of comments I heard from brokers recently. Like 50% of the existing deals that were active before COVID, are now on hold, which is concerning. And that there's been a 90% reduction in new deal volume, new activity out there, new prospects looking. And then of the 50% of the deals that are still active, most all of them are looking to do some form of retrade because of COVID, which is sometimes tough to justify in my mind.
Would you save the best for last? Tough information to digest. Yeah, I mean, the question is that just a temporary blip, or is that going to set the tone? I mean, a lot of projects we were working on a couple of significant ones, and both of these companies had taken a big hit to their business. Said, "Hey, we're going to wait 2020 out, and then revisit it." And I think a lot of people are, but it's setting the stage, in my optimism, for just an incredible recovery coming up next year. So I think we have to survive and stay doing the right things until the market comes back. Hey, we're down less than 5 minutes here. We should save a few get to some questions from the audience. Is there any questions you'd like to?
Yeah, honestly, I don't see much. If you've asked a question and you can't hear me, it's because I don't have my microphone down. If you've asked a question, in the early part, it gets pushed off my screen because there's so many responses for the continuing ed. So if you've asked a question, we didn't get to it, please ask it again in the next minute here or so these gentlemen can get to it. I thought it was interesting if you all maybe comment quickly on what we saw go through the chat room on when we're going to see a stadium full of people again. It was all over the board from, late, even summer to late this year. Somebody commented 2022. What do we do if it's 2022? Just keep doing virtual showings?
Mike Marsick says fall of 2020. Attaboy.
I think everybody has a different experience in this process. Some people have incredible fear and are very affected by it, and others are like, "What? I'm just keep going to my day, and it hasn't affected me." And it's for us, depending on where you are and what other side of the line you are of that, you can't have that be like you can't judge someone else for their opinion on fear. It's just what it is, fear. So.
Hey, we do have a good question here from Charles and Sam. Sorry, guys, I did see this one and I forgot about it. Construction costs, I suppose, probably goes best to you, Peter, but are construction costs going to spike? Are we going to see supply chain issues? Is that industry going to see some change happen?
Yeah, no, most definitely. Yeah. Construction prices are going to go up. There's no doubt about that. And that's just going to, again, affect the price differential that new construction is going to have to be priced at versus existing space. The benefit for new construction is the vacancy rate is so low, and existing space should be pushing rents if they're not. I know that kind of links MO coming to town, which is great. The days of 8 and 4, I think, are long gone. Matter of fact, I think the days of $4 warehouse rate should be long gone. I mean, it's time to be at $5 and $6 a foot for warehouse rate. And I think new construction is going to have to be all $650 and whatever the office build out, that's another way to measure that. But existing, shell space that's cold, wet, and dark should start at $6.
That was the old joke. I don't know what the question is, but I know the answer is 8 and 4 for rates. But that's not valid anymore. It was.
Get out your napkin.
It was for an awful long time. I think you have to say 10 and 5 and then build up from there. You think the 10 and 5, new 8 and 4?
Yeah, I think that's your rates are finally catching up to what it's cost to new construction, because you need those sort of rates, as you said, with the higher cost of construction nowadays. That's the only way those pencil out.
Here's another good one. I love this. What's the next major industrial portfolio? Which whale are you chasing down next?
You're looking at them right there.
Is there anybody left? Oh, there we go.
Peter's second largest in the state.
There you go. Peter, when are you selling?
Nope. No interest in selling right now. Looking to buy more. And so that's why I call Mark Folgerd every other day, and same with Judd Welliver.
Yeah.
Your best buddies. Mark, can I bring you something tonight? What do you want for dinner?
Bring it on, man. I need some food, man. So yeah, it's good.
Get the grill going.
I would say that there's going to be continue to be portfolios that are going to go to the market, and we see still a lot more opportunity where people. It depends on when they bought it and their exit. And so they'll be selling out of opportunity. They'll be selling out of strength. I don't think very many will be selling industrial property out of weakness right now, because I just feel like the bounce is going to be fast enough where there'd be no reason for someone to do a fast sale because they had a moment where the rent roll gets difficult.
All right.
Yeah, I'm going to scroll. We're out of time, but you can keep going. I'm going to scroll through everybody's contact info for you. We are recording this. I'll put the YouTube channel up on the screen one more time. So if you gentlemen want to go, if you go a couple minutes over, it's okay. If you drop off, it'll be on YouTube. Again, I'm going to scroll through people's contact information while you all finish up here. Thanks.
Were there any other questions from the audience that wanted to be addressed? I don't think any.
There was a question on cap rates for the next, in the shorter term, 6 months. Are these deals maybe that are being talked about now going to close at current cap rates? We're going to see downward or upward pressure.
Well, here's the quick thing I have on that is if you've had a few tenants that have had some free rent, or if you've had some tenants that have said, my industry has changed, I'm not going to be here anymore. So you might have some vacancy. So the cap rate on in-place rent probably isn't going to change. It's probably going to continue to fall. But there in these portfolios, there are going to be some holes that will open up. So, but I really think that cap rates will be similar or stable, and that's the math that we're working on.
Okay. Well, very good, guys.
Yes, thanks, gentlemen. Feel free to log off when you're done. I'm going to stay on and keep the chat room open for a couple more minutes. CE people, make sure you just put your name in one more time for Belt and Suspenders approach to making sure we get your head count in there. Take a look at the poll. We got some good information there. We have upcoming webinars. We're doing like 6 or 7 a week, so just watch your email for those. But we have a cool one coming up with some of the top women across the country for women in real estate, and then another one on apartments. And we've got some other national things coming up, so pay attention. Thanks, guys. I'm signing out. Appreciate everybody's time. If you want to go around and say a quick thank you, feel free. I'm going to disappear here.
Well, I want to thank the panelists. You guys really appreciate the time you spent thinking about it. Good quality communication to the audience. Thank you.
Yeah, thanks, Jim, for putting that together.
Yeah, Jimmy did a great job moderating us crazies. So.
All right, guys. I'll say have a good weekend if we know what they are anymore.
Yeah, blessings, everyone.
All right, take care.
Thanks, guys.
Bye.